Okay, students, the next topic which we will cover is liabilities. The next topic which we will cover is liability and its classifications. Okay, so what is a liability? Liabilities are the obligation or debts payable by the enterprise in future in the form of money or goods. Okay, so liabilities are the obligation or debt payable by the enterprise in future in the form of money or goods. Okay, now before we move further, we have to understand what is this obligation. Okay, what is the meaning of obligation? Okay, so what is an obligation? Obligation simply means, if you want to simply understand what is obligation, okay, obligation simply means an act of making oneself responsible for doing something. Okay, something, it may be as a promise or contract. Simple. Now see, say for example, you have a friend, this is you have a friend called Rema. Okay, you have borrowed rupees 1000 from Rema and you said that I'll pay this back in 20 days. Okay, now this act of you, what is the act you have done? You have borrowed money from Rema. Now to repay the loan back, to repay 1000 back, that will be your obligation. Okay, that will be your obligation. You'll be making yourself responsible to pay this money back within 20 days. Okay, so this is what we call obligation. Okay, now if I sum up what is a liability, okay, say for example, you are running a business. Okay, now you will be in need of funds every time, okay, to run your business. Maybe short-term borrowings, maybe long-term borrowings from bank, okay, or you may issue debentures. That's completely issuing of debentures is completely different concept. I'll not discuss it right now. Simply just understand that you have taken a loan from your friend, or you have taken a loan from the bank. Okay, now you have taken the loan. Now the repayment liability, who is liable to pay the loan back? You are liable. Your business is liable to pay the loan back. Okay, so liability is nothing but the obligation or debt payable by the enterprise in future in the form of money or goods. Okay, so let's see its classifications. Okay, classification. The first one is non-current liability or long-term liabilities. Okay, non-current liability or long-term liability. You may call it non-current liability, or it may be also called as long-term liability. Okay, now what is this long-term liability? Liabilities payable after a period of 1 year is termed as what? Long-term liability. Okay, example, bank loan, debentures, loan from friends or relatives. Okay, now this debenture part I will not cover right now. Okay, so just think that you have taken loan from a bank, or you have taken loan from your relatives or from your friends. Okay, now what do you mean by non-current? Non-current simply means long term. Okay, now when can we say a liability will be a long term liability? If the repayment obligation, okay, if the repayment obligation will arise after the end of 12 months, or I can say after 1 year. Okay, simple. Now see, you have taken a loan from bank. Okay, you have taken a long-term loan from bank. Now this loan will be paid after 1 year, say for example. Okay, now what will the bank charge from you? Bank will charge interest from you. Okay, interest per annum at the rate may be anything. Okay, as it changes, it differs from the type of loan you want to take. Okay, so this will be termed as non-current liability or long-term liability. Okay, now let's try to understand what is the second classification. The second classification is current liabilities or short-term liability. Short-term liabilities. Okay, what is this current liability or short-term liabilities? Liability is payable within a year is termed as short-term liabilities or current liabilities. Okay, what are the examples? Creditors, bills payable, bank overdraft, short-term borrowings. This may be from bank, this may be from relatives, or this may be from friends. Okay, and outstanding expenses. Outstanding expenses is also your current liabilities, right? So these are the examples of current liability. I hope you have understood, right? I don't have to explain it further. Those liabilities which you will have to pay within 12 months. Okay, that will be called your current liability or short-term liability. Okay, I hope the concept of liability is simple. Okay, students, now we will try to understand a very important concept: bills of exchange, bills receivable and bills payable. Okay, I would not say this is an important term, but this is a very important concept. Okay, in class 11 I guess you have spent around 16 periods, right, studying this, wherein you have learned in a chapter accounting for bills of exchange. You have learned about bill of exchange, promissory note, definition, features, right, and you have learned about due date, days of grace, days of maturity, discounting of bill, endorsement of bill, right? But in class 12, if I say about class 12, the main thing which you will need is you have to understand what is bills receivable, okay, bills payable, discounting of bill, okay, and another thing will be discounting of bill, dishonor of bill, dishonor of bill. Okay, you will be learning, basically you will need these three topics. Okay, in today's video, okay, we will only discuss about bills receivable, bills payable and discounting of bill. Okay, I will not tell you about dishonor of bill, because this is not a difficult concept at all, but as of now I will not explain what is dishonor of bill. Okay, so in future if you happen to take tuitions from me, I will obviously explain this in a very detailed manner. Okay, now let's start with our discussion. Okay, what is basically bills of exchange? What do we mean by bills of exchange, right? Bills of exchange can be of two types: bills receivable and bills payable. Okay, if you don't want to understand the concept, if you just want to know what this is, where we will, how will we do the accounting treatment of bills receivable and bills payable, it's very simple. So for example, you are the businessman. Okay, now if I talk from your point of view, bills receivable will be an asset for you. Okay, which simply means you have sold goods on credit and you have to get money from the buyer. Okay, it's not similar to debtors. Okay, it's not similar to debtors. There is a slight difference. Okay, and you can just understand that this is a kind of debtor. If you don't want to understand the concept, if you don't want to go with the conceptual clarity, if you just want to know how to treat this particular item, okay, similarly bills payable is also same as creditor. If you, again I will repeat, if you don't want to understand the basic concepts. Okay, now bills payable simply means we have purchased some goods on credit and we will have to make the payment later on. So this will be current liabilities, this will be a part of current liabilities, and this will be a part of current assets. Simple as that, if you don't want to if you don't want to understand, or if you are finding difficulty in understanding this concept. Okay, now let's start with the main concept. Let's start with the main concept. Now, bills of exchange. As you can see, I have made a template. This is how actually bills of exchange look like. Okay, it look like. See, now let's try to understand this with an example. Okay, let's try to understand this with an example. So, for example, there is a person called Mr. Seller. Okay, there is a person called Mr. Seller, and there is a person called Mr. Buyer. Okay, Mr. Buyer, he came to Mr. Seller. Okay, and he said, see, Mr. Seller, I want to buy goods worth rupees 1 lakh from you. Okay, but I don't have the money right now. Okay, I don't have the money right now. I will pay you after 90 days. Okay, now Mr. Buyer came to Mr. Seller. He said, I want to buy goods worth rupees 1 lakh from you. I'll pay you after 90 days. Okay, now what did Mr. Seller, he could not reply with, he did not have any reply. Okay, see, he was in need of customer. He was in a need of customer. He did not want to lose. He did not want to disappoint his good customers. Okay, Mr. Buyer was one of a good customer. Okay, second situation was Mr. Seller was also in a need of money, as his sales were down. Okay, Mr. Buyer came to Mr. Seller to buy goods worth rupees 1 lakh on credit, and the credit term was 90 days. But Mr. Seller, see the problem of Mr. Seller. Okay, Mr. Seller wants to deal only on cash. He don't want to go for credit sale. He just want to go for cash sale. But see Mr. Seller's problem. Mr. Seller, his business is down. Okay, his business is down, and he needs new customer, and apart from that, he don't want to lose his good customer, because in business, if you talk about real world, okay, credit term is very it's very common. Credit purchase and credit sales is very common. Okay, no one will give you cash instantly if you have a good business relation. Okay, Mr. Seller and Mr. Buyer has a good business relation. Mr. Seller and Mr. Buyer has a good business relation. So credit purchase and credit sale is very common in real world. Okay, now see, Mr. Seller was also in a problem. Okay, he also wanted to go for cash sale, but he did not have any money. So he had an idea. Okay, he said, why not I draw a bill. Okay, I draw a bill which will be called as bill of exchange. Okay, see, what will Mr. Seller do? Mr. Seller will make a bill of exchange. Bill of exchange will look like this. Okay, there will be a government stamp out here. Government stamp. Okay, you have to purchase it from the government department. Okay, we call it stamp duty, and the bill of exchange will mention the amount. See, 1 lakh rupees, right? Here he wanted to purchase goods worth rupees 1 lakh rupees. He wanted to purchase goods worth rupees 1 lakh. And Mr. Seller name will be here. Okay, address of Mr. Seller and the date on which Mr. Seller has made the bill. Okay, on the date Mr. Seller, this bill will be made by Mr. Seller. Okay, what will the bill mention? 90 days after date. 90 days after this date, the day on which bill was made, Mr. Seller, see, 90 days after date, pay 90 days after date, pay Mr. Seller a sum of rupees 90,000 only for the value received. For the value received. What does this bill of exchange tells us? That Mr. Seller has made a bill of exchange wherein he has written that 90 days after date. Okay, Mr. Seller, see, pay Mr. Seller. Okay, pay Mr. Seller a sum of rupees 90,000. Now, who will pay rupees 90,000 after 90 days? Mr. Buyer will pay to Mr. Buyer. See, this bill has been drawn to Mr. Buyer. Okay, now Mr. Seller will give this bill to Mr. Buyer. See, Mr. Seller will send this bill to Mr. Buyer. Will send this bill to Mr. Buyer, this paper to Mr. Buyer. Okay, this is simply a paper, it's a type of paper. Okay, this bill will be sent to Mr. Buyer. Okay, now what will Mr. Buyer do? Mr. Buyer has the bill. Now Mr. Buyer will take the bill, and what will Mr. Buyer do? Mr. Buyer will sign the bill. Okay, he will sign the bill. Say for example, Mr. Buyer, he will sign the bill. Okay, after he signs the bill, it simply means that he has accepted the bill. Okay, he has accepted the bill. Now after signing the bill, Mr. Buyer will again send the bill to Mr. Seller. Simple. He will sign the bill and he will send the bill to Mr. Seller. Okay, now this again, now here Mr. Seller will also sign. Okay, Mr. Seller will also sign. Now how will this bill work? Okay, now this bill of exchange will be a proof. Bill of exchange will be a proof that Mr. Buyer has purchased goods worth rupees 1 lakh from Mr. Seller. Okay, should I repeat? Let me repeat it again. Okay, there was a transaction between Mr. Seller and Mr. Buyer. There was a transaction between Mr. Seller and Mr. Buyer, wherein Mr. Buyer purchased goods worth rupees 1 lakh from Mr. Seller and agreed to pay the amount after 90 days. Okay, credit sales. If you talk from the point of view of Mr. Seller, it will be a credit sale, and if you talk from the point of view of Mr. Buyer, it will be credit purchase. Okay, now Mr. Seller was in need of money. Okay, his sales were down. Okay, he needed a good customer. Okay, and he did not want to disappoint his existing customer, so he decided to sell the goods on credit. Okay, now Mr. Seller is also in need of money. Okay, now Mr. Seller came up with an idea of making a bill of exchange. Okay, of drawing a bill of exchange, wherein the bill will mention the seller's name, the buyer's name, and the subject will be 90 days after date. 90 days after date, pay Mr. Seller a sum of rupees. Okay, Mr. Seller will order Mr. Buyer to pay a sum of rupees 90,000 after 90 days. Okay, this bill will be sent to whom? This bill will be sent to Mr. Buyer. Mr. Buyer will sign the bill. Mr. Buyer will sign the bill and send it back to Mr. Seller. Now what will happen? This bill of exchange will be a proof that Mr. Buyer had purchased goods worth rupees 1 lakh from Mr. Seller. Okay, Mr. Seller, and the payment will be done after 90 days. Done? Any problem? I guess there will be no problem with this. Okay, now see, for Mr. Seller, can I say this is a bills receivable? This is a bills receivable. And for Mr. Buyer, this is a bills payable. Simple. Bills for Mr. Seller, he has sold goods on credit, right? Obviously, it will be a current asset for Mr. Seller. And Mr. Buyer has purchased goods on credit, so it will be a current liability for Mr. Buyer. Simple. I hope you are clear with the concept of bills receivable and bills payable. Okay, now see, we are done with this bills receivable. We are done with this bills receivable. We are done with bills payable. Now discounting of bill. Okay, let me just quickly explain you what is discounting of bill. Okay, it's very simple. Just try to understand. Okay, now see, the Mr. Seller and Mr. Buyer part is done. Okay, now two party will come into existence. Mr. Seller and the bank. Discounting of bill. Okay, discounting of bill. In the concept of discounting of bill, bank will come into existence now. Okay, see what will happen. Mr. Seller was, as I have told you, Mr. Seller was also in need of money, but he did not wanted to disappoint his customer. Okay, so he decided to do the credit sale. Now Mr. Seller is also in the need of money. Now what will happen? Mr. Seller, okay, this is already signed. Okay, Mr. Buyer had accepted this bill of exchange. Okay, see, he had signed, Mr. Buyer. Okay, and he will mention the date. Okay, and Mr. Seller will also sign. Okay, now Mr. Seller will take this signed bills of exchange, accepted bills of exchange. Okay, Mr. Seller will take this accepted bills of exchange and go to the bank. Okay, you know what will he say to the bank? See, what will Mr. Seller say? Mr. Seller will say to the bank, sir, see, I have this bills receivable Okay, I will receive rupees 1 lakh from Mr. Buyer after 90 days. Okay, and Mr. Seller again said to the bank, sir, I am in need of money to run my business, as my sales are also down. Okay, Mr. Seller, he went to the bank taking this signed accepted bills of exchange, and he said to the bank, sir, see, I have these bills receivable. I will receive rupees 1 lakh from Mr. Buyer after 90 days. Okay, and again the Mr. Seller said, sir, I am in need of money. Okay, I am in need of money to run my business. Okay, as my sales are also down. Okay, so what did the bank do? Okay, now again see now the bank will accept these bills of exchange. Okay, the bank will accept these bills of exchange. The bank will accept this. Okay, now what will the bank do? Okay, the bank will, this is Mr. Seller and this is bank. Okay, Mr. Seller will give the bills of exchange to bank. Okay, bills receivable, and the bank will give Mr. Seller money, and and bank will give Mr. Seller the money. Now just give me a logical answer. Okay, do you think the bank will give him total 1 lakh rupees? Sorry, it was, I have written 90,000 here, no? Sorry, okay, this should be 1 lakh, my mistake, 1 lakh. Okay, see, I have written 1 lakh here, no? So this should be 1 lakh. Okay, you should just understand the concept, no? This is a slight writing mistake. Okay, so do you think the bank will give the whole amount of 1 lakh to Mr. Seller? Just give me a logical answer. I think your answer should be no. I think your answer should be no, right? If it is yes, I will reply to this answer later. If it is no, okay, you have given an absolute right answer, right? Why will bank not give him 1 lakh rupees? Why will bank not give him 1 lakh rupees? See, these bills will mature after how much days? After 30 days. The bill will mature. The bill will mature after 90 days. The bill will mature after 90 days, which means the bank will receive the money from Mr. Buyer now after 30 days. Have you understood the chain? There is a person called Mr. Seller, okay, Mr. Buyer and the bank. Okay, Mr. Seller first sent the bills to Mr. Buyer. Mr. Buyer accepted and sent it back to Mr. Seller. Now Mr. Seller went to the bank with the signed bill. Okay, now once the bank has given the money to Mr. Seller will be out of the picture. Okay, now only transaction will be done between whom? The obligation will be with bank and the Mr. Buyer. Okay, there is one exception. I would not say it right now. Now after 90 days, the bank will go to Mr. Buyer. The bank will go to Mr. Buyer. Okay, he will say, see, the bank will say, sir, you had purchased goods from Mr. Seller on credit. Okay, and Mr. Seller has given us this bill and taken the money from us. Now you pay us the money. Okay, now Mr. Buyer will pay the money to bank. He will not pay the money to Mr. Seller. Understood? Understand? So this concept is called as discounting of bill. This concept is called as discounting of bills. Okay, now when I asked this, will he get the total 1 lakh rupees? If your answer was no, you were absolutely right, because the bank will get money after 90 days. Okay, and Mr. Seller, he is in need of money right now. Okay, now he is in need of money right now, but he will get the money after 90 days. So bank will deduct some interest. Okay, interest on bills discounted. Okay, the bank will deduct some interest, and say for example 1 lakh was the requirement. Bank will give him how much? 99,000, say for example. Okay, so this 1,000 will be the income of bank in the form of interest. Okay, so this is all about discounting of bills, bills receivable and bills payable. I hope things are clear. If not, you comment. If you want, you can comment on the video and you can ask for proper clarification if you have any doubt. Okay, now next we will cover a very important concept. Okay, current account. I hope you have heard about this current account and bank overdraft. Okay, current account and bank overdraft. So let's write some definition. What is a current account? Who opens the current account? Okay, let's try to understand this first. Current account is opened by businessmen who have a higher number of regular transactions with the bank. Okay, it includes deposits, withdrawals and contra transactions, right? If you don't know what current account is, okay, what is a current account? Current account is opened by businessmen. Basically, this account is basically opened by businessmen, okay, who are running businesses. Now your parents will have saving account. You ask your parents, the bank account which they have will be called as saving account. Okay, there is another concept called as fixed deposit account. Okay, this is not so important as of now. Okay, this is not so important as of now. Now you ask your parents, okay, do you have bank account in your do you have any bank account? Okay, they will say, yeah, we have bank account in SBI or any other bank. So that will be called as saving bank account. Okay, where they get their salaries, from where they withdraw the money. Okay, that's called saving account. If your parents are not into business, they will not be able to open current account. Okay, so before we move further with current bank overdraft, okay, we have to first understand the basic difference between saving account and current account. Okay, current account basically it's same like saving account. The basic difference is it can only be opened by businessmen. Okay, there are other differences we'll discuss with the difference between saving account and current account. Okay, so difference between savings account and current account. Okay, we'll write just two difference just to make you understand. Okay, now point number one, a saving account is a deposit account which allows limited transactions, while a current account is meant for daily transactions. See, if you're running a business, okay, you'll have to do lots of transactions in a day, right? You'll have to give money, you'll have to take money, you have to pay for certain expenses, you will have to pay your creditors, you will have to receive from your debtors, right? But in case of saving account, right, your parents get salary, the maximum time they will withdraw is 5 to 10 times a month from the bank, right? But for a businessman, they have to do daily transactions, right? So current account is specifically meant for businessmen. Okay, now point number two, see, it will be defined in this point. Okay, a saving account is most suitable for people who are salaried employees, okay, or have a monthly income, whereas current account work best for traders and businessmen, or you can say traders and entrepreneurs, traders and entrepreneurs who need to access this account frequently. Right? Things are clear? Salary account is suitable for salaried employees. If your parents are salaried employees, okay, so they will be opening salary account. And current account is for traders and entrepreneurs, okay, basically for businessmen. Now in this account, in saving account, okay, in saving account, you'll have to, in saving account, no, you'll have to maintain low balance, okay. Minimum balance requirement will be very low, but in case of current account, minimum requirement is a bit higher, right, compared to saving account. Okay, so this is a basic difference between saving account and current account. I hope you have understood the difference between saving account and current account. Okay, because you will not come across this saving account. Okay, we'll only talk about current account in your accounting. Okay, so it's very important to understand, okay, current account. At the same time, we have to understand saving account. If anyone asks you what's the difference between savings account and current account, you are pursuing you'll be making your career in the field of accounting, right? So this is the basic concepts, basic terms which you have to know. Okay, so now the most important thing which I will be talking about is bank overdraft. Okay, this is very important concept. Okay, very important concept and very easy concept. So bank overdraft, let's talk about bank overdraft. Let's talk about bank overdraft. Okay, let's talk about bank overdraft. Now what is a bank overdraft? Bank overdraft is a type of financial instrument that is provided to some customers by the bank. Okay, so what is a bank overdraft? Bank overdraft is a type of financial instrument that is provided to some customers by the bank in the form of an extended credit facility, okay, which comes into effect once the main balance of the account reaches 0. Okay, wait, I'll explain you in a detailed manner. Okay, in other words, bank overdraft, you can also call it as bank OD short form. Okay, bank overdraft is an instrument. In other words, bank overdraft is an unsecured form of credit that is mainly used for covering short-term cash requirements. Okay, now see, just ask your parents a simple question, okay, regarding the saving account. Just say, mom, dad, if your account balance is 0, can you withdraw money from the bank? They will say, how can we withdraw money if we don't have any money in the bank, right? This facility is provided in current account. Okay, this facility is provided in current account. See, if the balance of your current account, if the balance of account is 0, okay, you can still withdraw money from the bank account. Okay, this is the facility which is provided by the bank to the businessman. Okay, not all businessmen, there are other terms and conditions which you have to check, but this is the basic concept of bank overdraft. Okay, so if I sum up, what is a bank overdraft? In other words, bank overdraft is an unsecured form of credit which is mainly used for covering short-term cash requirements. Okay, so what is a bank overdraft? Bank overdraft is a short-term borrowing. Can I say bank OD is a short-term borrowing? Okay, this is short-term borrowing. This is a current liability. Okay, so let's sum up with this bank overdraft. Okay, what is a current account? Current account is opened by businessmen who have a higher number of regular transactions with the bank. Okay, and we know what saving account, that's the account which your parents maintain if they are salaried employees, and current account is basically maintained by businessmen. Okay, now what is bank overdraft? Bank overdraft is a unsecured form of credit that is mainly used for covering short-term cash requirements. Okay, so for example, you are in need of money for 3 to 4 days. Okay, for 3 to 4 days. Now you go to the bank, okay, and you will ask for bank OD. Okay, so this is the short-term borrowing. You can call it short-term, kind of short-term borrowing. Okay, so this will be your current liability. Simple as that. Okay.